An overview of the Pension Benefit Guaranty Corporation, PBGC. The Pension Benefit Guaranty Corporation, PBGC, is a government corporation established by the Employee Retirement Income Security Act of 1974, ERISA, PL 93-406. It was created to protect the pensions of participants and beneficiaries by paying participants benefits if the pension plan is unable to do so. PBGC insures only private sector defined benefit (DB) plans. These pension plans provide a specified monthly benefit at retirement, usually either a percentage of salary or a flat dollar amount multiplied by years of service. Defined contribution (DC) plans, such as 401k plans, are not insured. More detailed information about PBGC is available in CRS Report 95-118, Pension Benefit Guaranty Corporation, PBGC, a primer. In fiscal year 2020, PBGC insured approximately 25,000 DB pension plans covering about 34 million people. PBGC operates two distinct insurance programs, one for single-employer pension plans and a second for multi-employer plans. Single-employer pension plans are sponsored by one employer and cover eligible workers employed by the plan sponsor. Multi-employer plans are collectively bargained plans to which more than one company makes contributions. PBGC maintains separate reserve funds for each program, and funds from the reserve of one program may not be used for the other program. PBGC Administration. PBGC is a government-owned corporation. A three-member board of directors, chaired by the Secretary of Labor, administers the corporation. The Secretary of Commerce and the Secretary of the Treasury are the other members of the board of directors. The director of PBGC is appointed by the President with the advice and consent of the Senate. ERISA also provides for a 7-member advisory committee, appointed by the President, for staggered 3-year terms. The advisory committee advises PBGC on issues, such as investment of funds, plan liquidations, and other matters. PBGC Financing. PBGC is required by ERISA to be self-supporting and receives no appropriations from general revenue. ERISA Section 4002 G.2 states that the United States is not liable for any obligation or liability incurred by the corporation, and some members of Congress have expressed a reluctance to consider providing financial assistance to PBGC. The most reliable source of PBGC revenue is the premiums set by Congress and paid by the private sector employers that sponsor DB pension plans. Other sources of income are assets from terminated plans taken over by PBGC, investment income, and recoveries collected from companies when they end underfunded pension plans. PL 96-364 requires that PBGC's receipts and disbursements be included in federal budget totals. Premiums. The sponsors of private sector pension plans pay a variety of premiums to PBGC. The sponsors of single-employer and multi-employer pension plans pay a flat rate, per participant premium. The sponsors of underfunded single-employer pension plans pay an additional premium that is based on the amount of plan underfunding. In addition, pension plans that are terminated in certain situations pay a per-participant premium per year for 3 years after termination. Except for the termination premium, the premiums are increased annually for changes in the National Wage Index. In 2021, the premiums are: single-employer flat-rate premium. The sponsors of single-employer DB pension plans pay an annual premium of $86 for each participant in the plan. Single-employer variable rate premium. In addition to the flat-rate premium, the sponsors of underfunded single-employer DB pension plans pay an additional annual premium of $46 for each $1,000 of unfunded vested benefits. There is a per-participant limit of $582 for this premium. Single-employer termination premium. The sponsors of single-employer DB pension plans that end in certain situations pay an annual premium of $1,250 per participant per year for 3 years following plan termination. Multi-employer flat-rate premium. The sponsors of multi-employer DB pension plans pay an annual premium of $31 for each participant in the plan. Pension benefit insurance programs. In the single-employer program, PBGC becomes the trustee of the terminated, underfunded single-employer DB pension plans. The terminated plan's assets are placed in a PBGC-operated trust fund. The participants in the trusteed plans receive their benefits from PBGC. Since 1974, PBGC has trusteed 5,031 single-employer pension plans. In the multi-employer program, PBGC does not become the trustee of plans. PBGC makes loans to multi-employer DB pension plans when the plans become insolvent. An insolvent multi-employer plan has insufficient assets available from which to pay participant benefits. Through fiscal year 2020, PBGC has provided financial assistance to 91 multi-employer plans. Single Employer Pension Insurance Program. When an underfunded plan terminates, the benefits PBGC will pay depend on the statutory limit on guaranteed benefits, the amount of the terminated plan's assets, and recoveries by PBGC from the employer that sponsored the terminated plan. Within limits set by Congress, PBGC guarantees any retirement benefit that was non-forfeitable vested on the date of plan termination other than benefits that vest solely on account of the termination and any death, survivor, or disability benefit that was owed or was in payment status at the date of plan termination. In general, only that part of the retirement benefit that is payable in monthly installments rather than, for example, lump sum benefits payable to encourage early retirement is guaranteed. ERISA sets a maximum on the individual benefit amount that PBGC can guarantee. The maximum pension guarantee is $72,409 a year for workers aged 65 in plans that terminate in 2021. This amount is adjusted annually for changes in the national average wage. In addition, the benefit is decreased if participants begin receiving the benefit before age 65, reflecting the fact that they will receive more monthly pension checks over their expected lifetime, or if the pension plan provides benefits in some form other than equal monthly payments for the life of the retiree. In fiscal year 2020, PBGC's single employer program paid a total of $6.1 billion in payments. Approximately 984,000 participants were receiving monthly benefit payments at the end of fiscal year 2020. Multi-Employer Pension Insurance Program. In the case of multi-employer plans, PBGC insures plan insolvency rather than plan termination. Accordingly, a multi-employer plan need not be terminated to qualify for PBGC financial assistance. A plan is insolvent when its available resources are not sufficient to pay the plan benefits for the plan year in question or when the sponsor of a plan in reorganization reasonably determines, taking into account the plan's recent and anticipated financial experience, that the plan's available resources are insufficient to pay benefits that come due in the next plan year. More information on multi-employer plans is available in CRS Report R43305, Multi-Employer Defined Benefit, DB, Pension Plans, a primer. If it appears that available resources will not support the payment of benefits at the guaranteed level, PBGC will provide the additional resources needed as a loan, which PBGC indicates are rarely repaid. PBGC may provide loans to the plan year after year. Only one multi-employer plan has repaid any of its financial assistance. PBGC guarantees benefits to multi-employer plans as it does for single employer plans, although a different guarantee ceiling applies. Multi-employer plans determine benefits by multiplying a flat dollar rate by years of service, so the benefit guarantee ceiling is tied to this formula. The benefit guarantee limit for participants in multi-employer plans equals a participant's years of service multiplied by the sum of 100% of the first $11 of the monthly benefit rate and 75% of the next $33 of the benefit rate. For a participant with 30 years of service, the guaranteed limit is $12,870. This benefit formula is not adjusted for increases in the National Wage Index or by any other measure of inflation or cost of living. Approximately 79,600 multi-employer plan participants in 91 plans received financial assistance in fiscal year 2020. In the next 10 years, 101 multi-employer plans covering 1.1 million participants are expected to receive financial assistance totaling $63.9 billion in present value terms. Current financial status. The most commonly used measure of PBGC's financial status is its net financial position, which is the difference between its assets and its liabilities. At the end of fiscal year 2020, PBGC's assets were $146.6 billion. PBGC's liabilities, mostly future benefit obligations, were $194.9 billion, and its net financial position was a deficit of $48.3 billion. PBGC is not at risk of immediate insolvency, because it has sufficient resources from which to pay benefits for the next several years. Since 2018, the single employer program has had a surplus. The surplus in fiscal year 2020 was $15.5 billion. The deficit in the multi-employer insurance program increased from $8.3 billion in fiscal year 2013 to $42.4 billion in fiscal year 2014 and to $63.7 billion in fiscal year 2020. The large increase in the deficit in fiscal year 2014 was the result of the increase in the likelihood of the insolvency of several large multi-employer pension plans in financial distress. Some policymakers are concerned with the financial condition of the multi-employer program. PBGC estimated that it is highly likely that the multi-employer program will be insolvent by 2026 and that it will almost certainly become insolvent by 2027. Both the single-employer and multi-employer programs are on the Government Accountability Office's list of high-risk government programs. John J. Topolewski, Specialist in Income Security. Elizabeth A. Myers, Analyst in Income Security.